The second method that we need to talk about for adjusting journal entries that I already mentioned was the alternate method for adjusting entries. This is the one that's a bit different than kind of what you're used to. So this is essentially, it's the reverse of what we did with standard method. So in this method, the initial entry doesn't go to the balance sheet, it's actually posted to the income statement first. Which means that when we get to the end of a reporting period, typically again, the end of the month, we need to do an adjusting entry, but what the adjusting entry does is it doesn't recognize the portion of the amount paid that needs to be an expense or the portion of the amount that needs to be a revenue. What it does is it sets up the prepaid expense or the unearned revenue. Okay, so in the last example that we did insurance and we had prepaid insurance. Well, we had that $120,000, and under the standard method we put the initial entry to prepaid insurance, and then we posted some of it to insurance expense each month. Under this method, it's different. It's actually the exact opposite. So that first entry when we make our insurance payment is actually going to go to the income statement, which means that when we get to the end of the month, we need to do an adjusting entry to reallocate some of that amount back to the balance sheet. And I'm just using insurance as an example. It's an easy one for everybody to grasp, but this applies to all types of adjusting entries, whether we're using doing prepaid insurance, prepaid rent, whether we're doing unearned revenue, any of those types of accruals or deferrals. The methodology is the same. Under the alternate method, the initial entry gets posted to the income statement, and then we adjust to the balance sheet. All right, so let's go back and let's take a look at that exact same situation. So if you remember in the standard method, Carter was the staff accountant at Blondia Rocks. He had been asked to record the payment of insurance premiums for the year, so it's for 12 months, on January 31st or on January 1st, totaling 120 grand. Let's see the entries he has to make on January 1st and January 31st. So on January 1st, he needs to record the payment of 120K. And then on January 31st, he needs to do an accrual. He needs to do an adjusting entry to set up the appropriate amount on the balance sheet. So if you remember, under the alternate method, the initial entry is posted to the income statement first. So when Carter pays that full premium amount on January 1st, which is $120,000, he's going to debit insurance expense, right? Income statement first, and then he's going to credit cash. Right? So this is the opposite of what you're used to. When he makes the full payment, he's going to debit insurance expense and credit cash. So the second entry we need to look at is January 31st, the end of that first month. Well, if you think about it logically, what's the problem? When we get to January 31st, let's say we don't do an adjusting entry, and you're the staff accountant, and you print some reports, and you do my financials, and you send me the balance sheet and the income statement. And you say, hey, here's the balance sheet as of January 31st, and here's the income statement, right? Right off the bat, when I take a look at that income statement, I'm going to know it's wrong because I'm going to see $120,000 in insurance expense if you don't adjust it. And I will know that that's not appropriate. I will know that we paid $120,000 for the entire year. So I'll send it right back to you and say that you need to do an adjustment. You need to set up our prepaid. Okay, so that's what the adjustment at January 31st does. We need to figure out how much of the total amount paid is actually still prepaid, right? So at January 31st, we have to do an adjusting entry, and because we're using the alternate method, that adjusting entry is going to go to the balance sheet, right? We're going to focus on setting up our balance sheet. Right now, we have nothing on our balance sheet for prepaid rent, or prepaid insurance, I apologize. So again, here's the calculation as to how I got to the $110,000, but we have an insurance plan that covers a 12-month period. At the end of January, we've only used 1 month, so we still have 12 months of coverage. Okay, but everything is sitting in the expense count on the income statement. So what do we set up as a prepaid? Well, we set up the 11 months that are still prepaid. So I take $120,000 and I multiply it by 11 out of 12 months. When you run that math, you'll get 110 grand. So we need to set up on our balance sheet a prepaid expense or a prepaid insurance for 110K. So the journal entry that Carter needs to do at January 31st is he's got to pull $110,000 out of the insurance expense and set it up as a prepaid insurance, right? And that's really all there is to the alternate method. It's just the exact opposite of the standard method. So in the standard method, when you get to the end of the month, you're trying to determine what should be on the income statement because nothing will be there. When you use the alternate method, everything's on the income statement. So what you need to focus on is what should be on the balance sheet. Now here's the trick. Once you've done this entry here, right? Once you've set up the prepaid insurance and the and pulled it out of insurance expense at the end of January, take a second to think about what the entry would be at the end of February. So again, 1 month has passed. What do? Well, the trick is that once you do this initial adjustment under the alternate method, you effectively default back to the standard method. Because if you think about it, when we get to the end of February, we have $110,000 sitting in prepaid insurance. So once I've set up the prepaid, I just do what I've been trained to do. You do what you've been doing in semester 1 and semester 2. You're going to take this $110,000, you're going to divide it by 11 months, right? So I don't know if you can see that calculator, but you take $110,000, you divide it by 11 months, and you'll see that we need to expense out $10,000 per month. So at the end of February, we would do a journal entry that debits insurance expense for $10K and credits prepaid. So you're back to what you're used to. So the alternate method, the only one that really is may trip you up is this first adjustment at the end of the first month, right, or at the end of the first period. Understanding that you're focusing on setting up the prepaid amount or the unearned amount and not focusing on the expense so much. Okay, so that's really the core difference. So just as a final reminder, under the alternate method for adjusting journal entries, the initial entry gets posted to the income statement and the adjusting entry gets posted to the balance sheet. So you have to be able to produce this initial entry as well as any required adjustments. As always, it makes sense right now. If you missed any of this or you're not sure, to go back and maybe listen to the lecture a little bit again or refer to the text or some overhead slides. And what I would recommend as well is to now go practice some of the chapter questions regarding alternate method and standard method. Just get used to looking at a situation where you've got to determine what's been done first. The question that you always need to ask yourself is what happened already? So is it all on the balance sheet or is it all on the income statement? If everything's been posted to the balance sheet first, then we do an adjustment to the income statement. If everything's been posted to the income statement, then we have to adjust to the balance sheet. That's the way it works.